Hey, greetings, everybody. Welcome into Mining Stock Daily. This is Trevor Hall, and you are listening to this week's long-form episode on the podcast. Thanks for tuning in. It was a pretty busy week here. A lot of corporate updates, some market analysis. We had some economic data come in, which actually had, unfortunately, provided some volatility in the metal sector, everywhere from precious metals to base metals. We're going to talk about base metals in general and exploration mining first with Joe Mazumdar of Exploration Insights. Great conversation with Joe. We hadn't had him on since February, so we had a lot to catch up with him. And then in our second segment, we turn big picture. We talk about a little bit of the macro and central banking with Bill Fleckenstein from Fleckenstein Capital, based out of Seattle. Bill's been on the show once before, but getting a general sense of why he continues to be bullish gold and really some of the mistakes he's seeing from central banks. So great conversation with Bill as well. This will be the last episode for a couple of days, holiday week next week here in the United States with the 4th of July. So we probably won't be back until midweek, so this will be the last episode for a number of days. Special thank you to Western Copper and Gold, Arizona Sonoran Copper, and Fireweed Metals for their continued support of the podcast. And if you wouldn't mind, press that like and subscribe on both the podcast networks and the new YouTube channel, on the Mining Stock Daily YouTube channel as well, where we're starting to publish a lot of the corporate updates in these long-form episodes. All right, everybody, let's jump into my conversation with Joe. Have a wonderful weekend. Happy 4th of July. Be well. Welcome into your first segment of this week's Mining Stock Daily long-form episode. It's going to be an uber long episode because next week we're coming into the 4th of July holiday here in the United States. So it's going to be a very short week in the markets and in the podcast and the YouTube channel as well. First segment here, we're going to spend a lot of time talking about junior exploration, a little health check with that sector, and also a lot of time talking about copper. Happy to welcome in an old friend. Last time we talked to Joe Mazumdar of Exploration Insights was at the Roundup conference earlier this year in February. A great conversation, one that I was really happy to have with Joe. So we are going to not necessarily relive, but maybe reapproach this conversation. Joe, how have you been? Welcome back to the podcast.
Thanks for the invite. All good here. How's it going down there?
You know what? Summer's finally here. We had I think we took all of Vancouver's rain this spring in Colorado. So it sounds like we got more rain in Colorado than Vancouver. So you're welcome for that.
Well, I noticed when I was down in Nevada and Idaho and Oregon about 3 weeks ago that that it was a lot greener, especially in Nevada, than I'm used to traveling around there. Also, the amount of rain stopped me from getting to one project because of all the mud.
Oh, really? I thought nothing stopped Joe from reaching a project.
Yeah, well, we had to pull that truck out, and then then we got stuck again, and then it was sort of like, oh yeah, okay, whatever.
You might have the thickest passport of anybody I've ever met in this sector. I assume you've been traveling quite a bit still this year.
Yeah, I'm sort of changing it a bit where I travel to a spot and then I try to do a few more trips because the kids are a bit older, so I can prolong my visit and have less like airport time because logistically that's more of a hassle than actually being on the ground.
Yeah, absolutely. So let's kind of jump into it here, Joe. It's a rough market out there for junior miners. A lot of companies, and we've been talking about this over the last week or two on the podcast. There's this bifurcation going on where the big miners, the producers, are making moves in this market to set themselves up for the next 20, 30, 40 years. So that is all happening while the riskier part of the sector, the junior sector, we're seeing 52-week lows. We're seeing capital that's hard to come by. And in fact, a lot of companies, I assume, are really struggling to keep the doors open right now. In general sense, before we kind of get into the nitty gritty here, how are you approaching this sector right now? What are you observing?
Well, if we keep to the mantra that Exploration Insights is about trying to find companies with projects that somebody else would want to acquire because we're mostly dealing with juniors, I have a few companies in the portfolio that don't require, an M&A, but if we just focus in on the ones that do, so we go through all the process to make sure that it warrants, it passes all the red flags with respect to, it doesn't have any with respect to potentially finding a suitor. The issue right now is actually funding these programs, and we've gone backwards, especially for precious metals, more so than maybe some minerals we consider critical. And in terms of the critical mineral path, there seems to be a lot more financing for those projects, especially lithium. I was in a conference in Quebec City recently, just last week, and there was a different. It was a stark difference between the lithium spodumene explorers and the amount of capital they had, and the gold explorers and what they were trying to do to raise just a couple of million.
Does this provide some direction for speculators in this sector of, where, if you're looking for any sort of reward for your investment, best to go look at a different metal than your typical, maybe a gold investor would typically look at?
Well, I guess you first frame it in terms of your investment horizon. So if your investment horizon is more than just 12 months, then, you might want to rethink your commodity focus. But still, I would say that on the exploration side, grassroots, a good drill, an excellent drill intersection in any commodity is, basically it's agnostic. It'll still drive the stock up and it'll still attract capital. But I would say, even over the last, 5 years or so, the amount of retail sector funding of juniors is diminished. And in this kind of environment right now, it's even lower, and such that people that work the prospect generator model that might have been disavowed several years ago when the capital was more plenty are now being looked at more seriously because they're attracting majors to fund them. And, being able to still produce decent drill programs in this current environment.
Yeah, it's interesting. It really is a major macro backdrop, I think, is the culprit for such a volatile sector in exploration here. The risk capital it's void of risk capital, I guess you could say right now. And I'm just, what is it about the macro here? I guess let me frame this differently, Joe. Why would somebody, if they had risk capital, why would they take a bunch of risk in junior exploration when they could go buy short-term treasury bills that guarantee yield in 5% in a couple months? Is that type of play taking away from the junior sector?
I would say that, there is that, the retail sector, the aging of the retail sector and their movement to more, because we get that from subscribers that have canceled, hey, we love the letter, blah, 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 but, I'm changing my portfolio and moving to lower risk sort of focus. And that might be dividend stocks. That it doesn't necessarily have to be treasuries, but, to more liquidity and to less volatility, which is totally understandable. So we're really competing with investors for that risky capital, that might be going into cryptocurrencies or whatever, marijuana, something else that people are looking for, your perennial triple bagger, five bagger, whatever, and their capital is something that they're, go in with the knowledge that they might lose it all. That's the capital the junior sector, the non-cash flowing junior sector is competing for. I think that entire pie of capital has been reduced, and now potentially there's a little bit more slices for other things. But I would say, the amount of news, headline news about critical minerals is definitely driving the bus for how some lithium plays and some other plays manage to access capital in current market conditions.
Joe, does there remain to be over speculation or froth in critical minerals or lithium plays that there once was earlier this year, or has some of that come off?
Well, I would say, probably no. It hasn't come off as much as if you were interested in the lithium sector and then you saw it, the lithium prices be one of the best performing commodities of 2022. And then when it dropped almost 60%, in the first several months of 2023, then you were looking for value. You would have, you wouldn't have had very many options because most lithium stocks didn't drop that much. And so at that conference I've just went to, I could go see, a $1.5 billion Canadian lithium play with no resource. I could see a 330 million market cap lithium play with prior to having drilled a hole. And then you take that, compare that to a copper play that's got a feasibility study, two strategic investors that own cumulatively 20% in it, cash, and where there's few development copper plays around, and that's trading at the same market cap as a lithium play that has yet to drill a hole.
What is causing this? I mean, I don't even know what he calls it. It's kind of ridiculous, Joe. I'm just going to say it's ridiculous. But what's driving? Yeah, what's driving this?
Well, what's driving it is that people are focused on critical minerals. They're getting all this news about governments and private equity and everybody else getting their foot into lithium, whether domestically or internationally, and a lot of money flowing into that commodity. Like we just recently heard, China getting into I think over $1 billion deal to get into the Salar de Uyuni in Bolivia, it's interesting times in terms of the lithium sector. And when you get bombarded by that news, then there's always this fear of missing out, and then people are looking for the next one, and the next one, and those ones that are over here are now being valued as if they were over there, and so on and so forth, while other sectors are totally abandoned because of the limited pie that we discussed before of risk capital has basically gone to this one more so than others.
Copper is not on that list of U.S. critical minerals. I would argue it should be.
That's after they did a revaluation, and because a lot of, I believe, senators or congressmen asked them to relook at, and the USGS did, and they still came up with the same answer, which was not, which I still don't understand. I'd really like to see how they evaluate what's critical and what's not critical. Because if they take the global resources in the U.S. by itself, maybe they think that they have enough to feed their smelter capacity, which is limited. But the problem is a lot of those resources as well, are they actually going to get developed? Are they including things like Pebble, where a lot of people don't think it's going to be built? Are they including things like Resolution, or whether it's the timing for Resolution, given that that's a project that's been around for about 25 years? So that would be interesting to me to see how they actually, decide what's critical and what is not.
Yeah. So let's jump into talking about Dr. Copper here, and I'd love to pick up the conversation you and I had back in February, Joe. It's interesting. I mean, there is quite this supply crunch going on in copper right now. However, the price action of the metal is showing weakness once again. Currently, I don't even know where we're trading at, but I think $3.75 a pound is the last I saw here. Obviously, Dr. Copper has been known to give us a lot of insights on the health of the global economy. That's one side of the narrative. The other side is this supply crunch going on, and I think I saw stocks at 15-year low. Any other time in history, when you see 15-year low, you would expect copper prices to be absolutely out of this world, but it's not. What's going on here? How are you balancing both sides of the narrative, Joe?
Well, I would take this as an opportunity if you believe in the medium to long term, and I do with respect to the supply side, because that's not something, you could fly some copper in from Mars or something like that that's going to come in. The timelines are the timelines. The the risk factors in countries that are major producers like Chile and Peru are real. And right now the funding is sort of on the shelf right now with respect to projects, even the brownfield projects. So on the supply side, I'm pretty confident it's not going to be there in the medium to long term. Then on the demand side, medium to long term, the question is how many EVs actually get, produced? What is the penetration rate of electric vehicles? But more importantly, because we don't talk about this as much because a lot of focus is on electric vehicles, but not so much on the electrification of, green energy like, solar, and all battery storage, all this other stuff that requires infrastructure, and copper is the infrastructure. So in the medium to long term, battery technology can change, and that element that you're looking at may not be used anymore because the price goes up and technology is not a constant. But the infrastructure part of copper is what I'm more confident in. So again, medium to long term, confident on the supply situation being favorable for the price. On the demand side, yeah, there's issues medium to long term in terms of what I just said. But in the near term, the issue is that, the rebound in the Chinese economy is not as strong as people thought. And when people look at inventories, they got to realize there's visible inventories and there's inventories you don't know about. And so when I worked in the copper market, we had visible inventories at the London Metal Exchange, Shanghai, and we also had the COMEX, but also at that time, Codelco was stockpiling, but they left that as visible so you could see. So visible inventories, which was a bigger portion of total global inventories. The problem right now is there's a lot of inventories in manufacturers that we don't know about, and it's hard for us to gather how much is out there. So they hold these inventories, and when the market picks up, the first thing they do is use their own inventories before they go to the market. Other people, if they can't, get those inventories or don't have them, then they will drive the global inventories down. What we really, I hate to look forward to this, but, back in the, the 2000s, the market was teetering on an edge because the inventories, like you said, were low. But it took an event like a big rock slide at Grasberg to take a significant amount of copper off of the market that pushed everybody into the market, and slowly, then copper went over $1, slowly rose over to $2 because they knew that copper wasn't going to be there and everybody was scrambling. So what I see right now is that the M&A in copper is positive. I mean, there's a good trend there for people acquiring assets, but right now they're acquiring producing assets. That's not going to change the supply of copper, but it's indicative to me that the sector knows there's an issue. Now what we need to see is some of these development plays get acquired. We need to see more funding of grassroots exploration. We need to see a lot more of that, and that will happen, I believe. But right now I'm still positive on copper long term, medium to long term, and I'm also the signs in terms of M&A are good, if not the copper price.
Obviously South America is the largest producer and exporter of copper, and we go from Chile to Peru to Argentina. I'd like to ask you about Argentina here, because it's lots of exploration happening in along that Chilean border right now.
Yeah.
And I don't necessarily want to, we can talk about, obviously I'm just looking at NGEX has made a new all-time high today as we speak, which is very fascinating, while the copper price is down. But I actually want to ask you more of a geopolitical question, because there is an important election happening in Argentina, and Argentina has been a kind of a political basket case for my entire life. However, how closely are you watching this election? What potentially does it mean for the mining sector in that country?
Well, what you got to understand is that, Argentina, this is a federal election coming up, but, how they do it federally in terms of infrastructure and how to basically make it easier for people to with the tax breaks and capital flow and that's what the federal government can do. But the federal government cannot make like exploring in a certain state or a province of Argentina any easier. So let's say the federal government becomes right and they want more foreign direct investment, and they love mining, they love oil and gas, they want to attract more investment. But that's not going to make it easier for, let's say, Pan American Silver to get a permit to build Navidad in Chubut. That's not going to happen. It's not going to make it any easier for anybody to do anything in the province of Mendoza. Like, no matter what kind of government we've had, Santa Cruz has always been a good state in terms of mining, San Juan, Salta, and Jujuy. So we've seen M&A in the lithium sector in Northwest Argentina, regardless of the who's been running the country. So I don't put as much weight on the federal election as maybe some other people, because really at the province level, nothing changes. It just makes the tax, and people looking to come into Argentina, who don't have assets there already, that's important. But for other things in terms of development, it's really a province to province thing, and I don't think that's going to change.
How about the other side of the border into Chile? They elected a very young president. And when I was there visiting Vizcachitas a couple of months ago, one of the things that I was told was like maybe this man couldn't be as far left as he originally ran on. Then the next day, literally while I was there, they ran on that the lithium
nationalization.
I mean, for lack of a better term, nationalization, kind of replicating what they did with Codelco. So, is there potential that maybe that far left fears from the mining sector in Chile are subdued, or is there still quite a bit of concern of unknown of what's going to happen there regarding the copper sector?
Well, I mean, definitely with foreign direct investment in lithium, that's going to be problematic. That might not impact, it will not impact the lithium supply in the near term, because the major producers like SQM, Socomish, and Albemarle have leases. Granted, SQM's expires sooner, I think 2030, whereas the other one is past 2040. That's not going to change production from the Salar de Atacama for those two, for another 7 years, and for the other one, more than a decade. But for people that want to come in and explore, like people are doing in Argentina, that it will make a lot more capital go to Argentina and other places rather than, and then probably back into your spot, you mean dikes and stuff like that in northern Quebec or other places, rather than fund brine exploration in Chile. That'll definitely happen. It's probably already happened. With respect to the problem is probably the contagion domestically as to, hey, this lithium nationalization thing looks pretty good. Why don't we try copper again? When they already have a state-owned company. The problem is the state-owned company doesn't have enough capital to build all these projects. And if you start taking things away from people, they're reluctant to invest. And so my big indicator there in terms of Chile is to find out what Freeport does with the El Abra expansion. And so Cerro Verde was expanded, and both those projects, when I worked for Phelps Dodge, were solvent extraction, electrowinning. So they're looking at the enriched blanket. When copper prices were lower, those were the grades that made sense. But copper prices went up, such that now they're mining the lower grade sulfide. That requires a mill, and then you produce concentrates. They did that at Cerro Verde in Peru, and they were looking at doing the same thing in El Abra in Chile. However, Freeport has sat on its hands a bit, waiting to see what this new tax regime would look like. That's out now. And I'm sure they've crunched the numbers, but they have yet to make a decision whether, from what I know, whether they're going to build that or not. That's a multi-billion-dollar investment. And when we look at copper supply and demand fundamentals, a lot of people may have modeled this coming in as if it was going to happen and they were investing now. But, that's already been delayed more than a year. So, it's bullish for the copper price, but not so bullish for Chile.
Yeah. One of the topics I really wanted to ask you is about Rio Tinto's Nuton technology. And I have been waiting. I was waiting anxiously to see which company that Rio Tinto partnered with Nuton was going to come out with the first, preliminary results. Partners of the pod, Arizona Sonoran Copper, who I know you follow closely, published some of those preliminary results, early met results from the data a couple of weeks ago, I think it was. And obviously preliminary, you got to take it with a grain of salt. Arizona Sonoran's not jumping out and trying to put economics on it whatsoever, but it was promising. And that was the first sort of data set from Nuton that I saw. It looked pretty good, Joe. And I'm just kind of curious what you saw from that data set and, what this really means for other partners that Nuton is working with down the road. And does this really have potential to be a big disruptor of copper supply down the road?
Potentially. Like I've worked with new technologies in copper extraction when I worked for Phelps Dodge, like leaching of concentrates and avoiding smelters. The whole idea here is to avoid smelters and produce cathode locally. Mm-hmm. That's the big deal. And since just erosionally and where we are in the world and how much we've mined of oxide and enriched, there's much less of deposits that are amenable to the traditional solvent extraction electrowinning. That's basically what this is trying to do, like a heap leach, but what it's using is bacteria that love sulfides. They love pyrite, basically. And by them consuming pyrite, they basically oxidize the ore, the copper ore. But there's a range of types of copper assets that have that kind of pyrite in them. And that's why they always test metallurgically each deposit before they do the initial equity stake. And then they do a preliminary, which is what they just released with Arizona Sonora. But this is really preliminary, and I don't put much weight on any of the results just because the columns that they tested were about half the height of the ones Arizona Sonora uses for their, PFS, pre-feasibility study met work. What I want to see is replicating those kind of columns, and what you need is that kind of, how long does it take to leach? And to get an 80% recovery, something like that for copper, that would be a boom. That would be saying, wow, now this looks pretty interesting because you're saying 80% and then maybe I can get 90% into a concentrate, or something like that, 88 to 90% of concentrate. But the problem is that then I have to pay freight, ship that concentrate to wherever, which is usually Asia, and then I have to pay my treatment and refining charges, which could be anywhere from 15 to, if it's really bad, 30% of the copper price. So when you do the math, what recovery would give you that kind of return without the freight, without the TCRCs and everything like that? And is it a wash? That's your starting point. Right now they're not there in terms of Arizona Sonora, but Newton's got the same thing with McEwen Mining. They're trying to test it there. They've signed an agreement with Regulus up in for the Antiquary project. But what you got to really know is that this technology is right now just for copper. So if you've got a porphyry that's got the pyrite that can make the bacteria happy, keep them alive, then your problem is that that gold that you have, or potentially the moly, definitely the silver, you might not get any of that. So if you work in copper equivalents, just think copper until they start showing recoveries for byproducts, because right now I haven't seen any of that, and I don't think you get that. In Arizona Sonora, they do have some moly, but they don't have a big credit right now, and they don't even produce a moly resource as far as I'm aware. So that's what you want to look at. So, in terms of breaking, breakthrough, yes, but for certain types of deposit, it's not a one size fits all. It is definitely not a one size fits all.
Very interesting. And thank you for the other side. That's something I hadn't thought of. But the recoveries alone, I mean, so you would like to see generally with the technology something like 80 to 80% of recovery.
Yeah, I don't think, 80%. Then I'm like, great, let's do it. But we got to understand from the Arizona Sonora point of view, the sulfide's not even being considered as part of their economics right now. It's all upside. And right now, to do the concentrate, if they ever do it, which wouldn't be till, let's say, year 6+, where's the copper price going to be there, at that time? And at that time, maybe just having a mill producing a concentrate at that time might make sense. Right now, it doesn't, in terms of the capital input required, operating costs and everything like that, and it's all underground. So right now, I don't think that makes sense for them, and they put it out that it probably doesn't, and they haven't drilled enough of the sulfide to know how much is out there to get, because usually when you're looking for oxide enriched, once you get into the sulfide, you stop drilling.
Yeah.
So all the old holes they have don't help them.
Speaking of Arizona Sonoran, Ivanhoe Electric is exploring the same deposit down dip there in Arizona. Robert Friedland was on Bloomberg this week, basically claiming he's going to be a gazillionaire when the copper price.
He isn't already? What's that?
I think he's only a billionaire now.
Okay.
But I mean, it was pretty interesting. I mean, he was obviously very bullish on the copper price. You have to be. He's always been. But it was interesting. He was calling copper's heading for a train wreck here based on the supply demand. Now, some of the presentation he was giving on Bloomberg, I've seen enough Robert Friedland to know, he was kind of had this sly grin on his face, and I somewhat appreciate that a little bit, actually, given how successful he's been. But, he really put it out there. In the back of my mind, Joe, I'm also thinking, listen, Rick Rule has always taught us the solution for high prices is higher prices. And at some point, if copper is going to go higher in the long term, there's going to be something to bring it down. Maybe this Newton isn't it. Maybe it's a oversupply of copper coming from so much capital hitting projects to get developed. But we're nowhere close to that. we're nowhere close to that. But we got to start. We got to start thinking that way.
If we look at the development timelines, we're talking 15 to 20 years from knowing a project, from actually discovering it, to potentially getting it into construction, just thinking that everything works. Not like, hey, a trilogy where you spend 5 years trying to permit a road and then you get the permit, then a year and a half later they take it away. That can't happen. Resolution, I think I've told you this before, like when I worked as an analyst for Phelps Dodge, we had it coming in at 2010. It's now 2023. It's closer, but I don't know closer to what. So, I think he's absolutely correct with respect to being focused on copper, and it's through his, investments, work, and his team that the DRC, the Congo, is competing with Peru to be the second biggest producer of copper, partly because Peru has come backwards, but, also because the DRC with Kamoa-Kakula has taken such a large step forward.
Yeah.
And that's without any major Western company producing copper in the DRC. First Quantum pulled out and Freeport pulled out already. And I don't see many more people going in yet. So that's basically mostly Ivanhoe Mines that's doing this.
But there does seem to be a little bit of geopolitical interest from East and West in DRC right now, because I have a good friend who's from DRC. He's very much interested in what's going on in the mining sector, although that's not necessarily where he works. But he said that every time I talk to him, he's like, the Chinese are doing this. Yet on the next time I talk to him, the U.S. is doing this in the DRC. And it's quietly, this tug of war is quietly going on in the DRC between the East and West, and it's not making a whole lot of news headway here. But it is, if you look closely, you will notice that it is kind of a middle, a big ground for where resources are going to come from between the two.
Yeah, no, I absolutely agree. So I was in Indaba in South Africa in February, and in November of last year, Anthony Blinken, the Secretary of State for the U.S., he was in the DRC in Zambia trying to do a bilateral agreement there. And so that's what the U.S. is doing, is trying to do a lot of these bilateral agreements, trying to get the copper and the cobalt that they require. And, Zambia and the DRC have quite a bit of the Central African copper belt. And some of those deposits obviously have a lot of cobalt. So there is interest, but the DRC is wary of both sides. So the Chinese investment that has been there for a while, helped them with infrastructure. Now they want them to pay it back. Whereas their loans from the West, a lot of those were forgiven. So they have that issue. They also have an issue with, artisanal mining by the Chinese in their country. And that's really catching a lot of the locals offside. And so there is some kind of animosity there. And now, the U.S. government has to make the DRC basically very appealing for Western companies like Freeport, First Quantum, what have you, to come back in to the DRC. They got to provide some assurances and provide some investment in terms of the infrastructure, the same kind of infrastructure that the Chinese have built. And Zambia, I think, is probably a better spot with respect to companies coming in, because when I went to Zambia last year in October or something like that, there was definitely a lot more companies there working. I mean, there's that new company that Bill Gates sponsored, Cobalt.
Yes.
That just IPO'd, and I think over $1 billion. They bought an asset right on the border of the DRC in Zambia, a copper asset for $150 million. So they're quite active. I think they've hired most of the PhDs that are employable in the Western world. So we're seeing a lot more activity. Definitely, we are definitely seeing a lot more activity, especially with Peru being the way it is, and Chile maybe being a bit, negative right now in terms of potential creeping nationalism. Zambia has sort of turned the corner with its new president. I know that the DRC and Zambia are talking more about sharing infrastructure, and everybody and their dog is talking about building battery infrastructure locally. But I mean, it's impossible that, Zambia and the DRC need so much basic infrastructure like roads and ports and electricity that I don't know how they get to where they want to get to without having that basic. If they could get the ports, if they can get the roads and they get the power, that would be good enough for most mining companies.
Joe, one last question, because I'd be dismissive if I didn't ask you about gold exploration right now. I'm sure a lot of your subscribers are chiming in, asking you questions. Gold equities, especially on the junior side, are really beat up. The name of the game of investing is to buy low and sell high. So, if you're not buying right now when nobody else is there a better opportunity now, or is there just too much unknown to start deploying cash into the gold equities?
So I have done a few private placements in gold and some in gold in Mexico with the mining reforms in place, just because I think that's not a bad spot. And if you got the land, great. And, and then the most important thing is people with experience in that environment. That's the important thing, and know the rules, the regulations, and how to manage in that in that climate. So I would say yes, in terms of everyone being very negative on gold. This is where you can definitely get the right people, the right asset at a discount. That's definitely the case, more so than probably some other assets. But, that's sort of also tracking to copper as well. but definitely for gold and silver, especially since there's not a lot of silver dominant projects. And if we've got problems in Peru and Mexico, those are the two of the bigger silver producers around. That's another issue with respect to that precious metal.
Yeah. Okay. Joe, hey, thanks for your time. I really appreciate you doing this. Good to connect once again. Before we let you go, let everybody know where they can find you and Exploration Insights, and maybe inquire about a subscription. It's one of the best newsletter out there right now. I mean, it actually has always been one of the best newsletters.
Thank you. Well, I got remarked by the fellow I bought this from, Brent Cook, that a lot of people don't know I write a newsletter, so he says you got to plug it more. So here you go. It's explorationinsights.com, weekly publication on the mining sector and what I'm buying, what I'm selling, and a lot of thematics. And like Trevor was saying, a lot of my site visits. There's some free material on there, so you get an idea of what we do, and also follow me on Twitter or LinkedIn at Joe Mazumdar or at Exploration Insights, and you'll find some of our stuff that we post with interviews. I just did an article for the Assay, the 1-to-1 mining assay magazine on critical minerals that people can get access to.
All right. Awesome. Joe, thanks so much. Have a great rest of your week. All right, everybody, we are back here on our second segment of this week's long form episode on Mining Stock Daily. We're going to focus on really the big picture thing here, and happy to welcome back somebody I've admired from a distance. He is the man over at Fleck Capital, and he also co-hosts an incredible podcast called The End Game with Grant Williams. Happy to welcome back in Mr. Bill Fleckenstein. Bill, welcome to the podcast. How you been?
I've been fine, and thanks for having me back.
Yeah, summer is. I assume summer is treating you well. Are you void of the heat?
Well, in Seattle, the People's Republic of Seattle, where I reside, a lot of times summer doesn't begin until like mid-July or August. We've been lucky this year. June's been quite nice. So yes.
Oh, very good, very good. Well, I think we've gotten a lot of that rain that Seattle usually gets. We get that in Colorado all of a sudden. We've had monsoon season here. Let's jump into it, Bill. Listen, there's a number of directions we can take this conversation, but we are recording this Thursday morning, and so I think it's just best to kind of jump on some of the big data point that was published this morning. Jobless claims came in. It was decreased. It's at least since 2021. The bond market is making moves off this news, and obviously the stock market is kind of making moves, but precious metals they started to fall into the floor before we get in a buy here. I mean, this is kind of a big picture thing here where we talked about for the last year and a half, these increased rates from the Federal Reserve trying to tamper down demand. We can have the argument that there will be more based on some of this data, but then we can continue to have the conversation that, well, the higher they increase, the more likely something is to break. I'm just kind of curious in general, to start the conversation, how are you approaching all this? What are you seeing in the economy that would continue to allow the Fed to continue to increase interest rates here before maybe they start an official pause, or even, do we say, cut?
Well, first of all, what you have to know is the people at the Fed really don't know anything. Now, I'm not trying to be hyperbolic when I say it that way, but if you look at the reverence with which what they say is treated, whether it's a speech or the minutes or whatever it is, they are treated as though they are infallible and omniscient, when in fact, the reason we're kind of in the predicament that we're in now is because of their mistakes. I wrote a book that was published in 2008 called Greenspan's Bubbles, The Age of Ignorance at the Federal Reserve. And what I hope to do, what I had hoped at the time would come of that, what people would realize how dangerous the FOMC was in its ability to warp and change things. So fast forward, giving the cliff notes from 30,000 feet, we had a stock bubble was precipitated by Greenspan being too easy. The Y2K money blew the top off. Then we had a recession. They panicked over that. They started doing the same thing they'd done before. We created a real estate bubble. Anyone with an ounce of brains could see that both of those were bubbles. I went on TV and talked and wrote quite a bit about it at the time, trying to warn people of, what the dangers were. In fact, I gave a speech in downtown Seattle, and it was the front page above the fold headline news that, hedge fund manager says real estate can decline, or some stupid headline like that. The point was, that's how drunk people were. They didn't think the price of real estate could go down. Of course, Greenspan helped create that when he and Bernanke kind of helped foment the real estate bubble. I don't want to litigate that. The point is, when that burst, they got even crazier with QE. And then they said they were going to take it back, and they never did. And then we had the repo problem, and they started it back up again in 18, 19, late 18, early 19. And then, of course, we had the coronavirus / lockdowns, and they did it again. And then they kept on doing it, and they never took it back. And they said inflation was going to be transitory. And now everyone wants to act like these people are without blame for any of the misallocations of capital. In addition to that, when they've done that, they've allowed the government to kick the can. So we've been able to run these massive deficits, and there's never any pain associated with that. We haven't used any of the time in the last 10 or 15 years to get at the entitlement programs, which I'm sure everyone's seen clips of Stan Druckenmiller's talk about, how that's going to engulf us in the next decade, and it will. Meanwhile, I got to get something for you here. These guys at the Fed were cheering on inflation. I'm going to read you something that I clipped out of the FT. This was July of 2019. Headline: Powell seeks a cure for the disease of low inflation. Now, does anyone with an ounce of brains actually think that low inflation is a problem? No one does. Nobody wants inflation. And yet these central bankers, not just the Fed, but the other knuckleheads too, decided that 2% was the magic number we had to have. And that was not in the Fed charter. They just made it up. And one of the quotes, he said, we've seen it in Japan. We're now seeing it in Europe. And that's why we think it's so important that we defend our 2% inflation goal here in the United States. And we're committed to doing that. Okay. What they've said they've seen is deflation. Well, what deflation is productivity, technological tools. Who's against that? What they mean when they say deflation is depression, right? Mm-hmm. They associate deflation with depression because in depressions you do have deflation. But they have bastardized these terms and are always yapping about deflation being bad, and it's not bad, and unless it comes with an economic train wreck, but it's not something we face because their fear of that is exactly why they keep repeating these irresponsible policies. So I got off on that tangent because I'm trying to make it clear that these people have all this credibility and they don't deserve any of it. So if all the central banks in the G7 countries were not doing the same thing to various degrees, we would have a problem with the currency. But since they're all doing variations of the same thing, except, perhaps maybe in Japan, they're going to end yield curve control. I happen to think they will end it this year. But in any case, so the policies are set to cause your currency to depreciate against goods and services. That's what inflation is. Mm-hmm. I'm not talking about necessarily a dollar FX crisis because it's hard to have a crisis when everyone else is just as bad as you are. That's not to say the dollar can't decline and slide. And if the yen were to rally because the Japanese ended yield curve control, you might see a weak dollar. But anyway, the point is I'm trying to set the stage for the number one economic problem we have in this country, I believe, is the Fed in terms of the distortions that they cause and the ability that they have to allow the government to kick the can and keep spending beyond its means until we get to the moment in time when we have to deal with it, and then it'll be too big to deal with. So I don't mean to be a tinfoil hat type of, the Fed's doing this and all. I'm not talking about that. I'm talking about the economic consequences, direct and indirect, of their policies. So you asked me, I can't remember what question you asked me. Up on this tangent.
General approach of what you're seeing.
The fact that Bill Dudley was being slightly honest about a potential bond train wreck.
Right.
Well, we can easily have a bond train wreck because we have so much debt to finance. We got to refill up the Treasury general account. So, how that plays out and how much has been discounted, I don't know. But I suspect there will be trouble in Treasury bonds until such time as we have some sort of financial market accident or financial market accident or economic data softens.
Yeah. So Bill Dudley, you just quickly mentioned, he's the former Federal Reserve Bank of New York president. He wrote this op-ed in Bloomberg, which was published this morning, and he said the economy is still strong, labor market extraordinarily tight, and inflation stubbornly high. The Fed Reserve will probably be taking short-term interest rates higher for longer. Obviously, the economic data we got out from the jobless claims obviously supports that. There's a revised GDP up to 2%.
Let me stop you there, because we're engaged in looking in the rearview mirror.
Right.
Employment is a lagging indicator. Now, some might argue it's coincident, and some facets of it might be more coincident than others. But the employment data also has the birth-death model, which is the BLS's attempt to figure out business formations and things like that. It can be wildly inaccurate. Mike Green made a good point on it recently about the fact that where we are in the current business cycle is skewed unusually to more white-collar layoffs than blue-collar layoffs.
Sure.
Blue-collar layoffs are more likely to end up with somebody claiming unemployment. Whereas if you were making $250,000 at Google with stocks and options, you're probably not going to file for unemployment claims and make $500 a week. So I think the claims data is not representative of what's really going on. And the employment data itself is skewed with the birth-death model and assumptions like that. It's essentially a made-up number. I mean, they don't make it up. I don't mean to say that they just, but it's contrived, and that's why you see all these revisions as you go forward in time. So there's this huge fascination or infatuation with the employment data because that's what the Fed's looking at. And I just gave you my rant about looking at the Fed. So all this is wrong-headed. The economy is slowing down. There are employment problems in some places, and there aren't in others. We have this out-of-control government spending, which hasn't mattered for 2.5 decades, which is how it got so out of control. But now we're getting into really gargantuan numbers, and we're going to be dealing with an environment where, all the big buyers of the past 5 years are liable to be absent. So it's liable. It's going to be a problem. I think earnings for the market, for companies to report in Q3, there's going to be some pressure. It's a little different in now versus the last 20, 25 years in that inflation can help companies make numbers. So sometimes they're making the numbers and it's really not anything organic like it had been for the prior 2 decades. Anyway, to be all focused on the employment data as the only thing you're going to trade, to me, seems rather short-sighted. On the other hand, if you're a trader and that's what they're trading, you got to play that game if that's what you do.
Yeah. Let me open up an idea here, Bill, and you can tell me if I'm way off kilter here or not. But there's this discrepancy. If we talk about jobs in the United States, there's this discrepancies. You mentioned the white collar jobs, the tech jobs. Those are we're seeing the biggest number of layoffs here. And pragmatically, and I'll be honest with you, I was surprised. I was driving to Denver International Airport the other day, and along I-70 in the industrial area of town, there was a sign. They're looking to hire HVAC technicians, and they put $250,000 a year up on this big billboard. That's damn good money. So obviously the blue collar positions, I mean, there's a lot of openings in those types. But does this represent, and I'm trying to think back, we've had conversation the last couple of weeks where somehow we need to go back from producing financial mechanics to actually producing goods.
I think there is a definite increased demand for people to make things. Particularly, I think that's also associated with the supply line changes that are coming in the wake of COVID and or friction with China nowadays. So I think there will be more those kinds of jobs, and obviously not directly for HVAC, but if you're going to build a new plant, you need HVAC. So it all kind of rolls into one.
Right.
Yes. So I think there are more opportunities in various blue collar type jobs than there might be in certain quote unquote white collar jobs. But the way past business cycles have gone, the layoffs have hit the lower paying jobs earlier, and that's been the deterioration that you've seen in the employment data with the long lag, and that's what the Fed's looking at. Not really cognizant of the fact that data is not very good, and particularly doesn't fit this current cycle, because we've seen with a lot of these tech companies where all that massive hiring went on during the lockdowns, and now there have been a lot of cutbacks there. Microsoft, Google, Facebook, all these companies, their stock prices are soaring, are also announced a lot of layoffs. Now, maybe all those people will go get new jobs and they'll be at the same salary level. I kind of doubt that. But anyway, I'm just saying there's a different wrinkle in the labor force than we've seen in the business cycles of the last 20, 25 years.
Okay. I think 4 of the heads of federal banks were in Portugal this week, and not to dive into every single thing they said verbatim, but they did mention, a lot of them said the biggest surprise that they've had is the resiliency they see in their own economies. Resiliency, I think, is a pretty far stretch because they all printed so much money. We're still seeing some of that work off. I mean, do we need to be cognizant that resiliency just means that money is still in the work, still working around? I
think when they printed as much as they did for as long as they did, they warped things and created such misallocation of capital. They created also a lot of inflation. And so we haven't had a business cycle that was ended due to trying to fight inflation that was here and real, really since the 70s, late 70s, which ended, with Volcker finally knocking down inflation. So I think that they don't understand that either. Therefore, the data looks a little different. Like normally I accuse them of being irresponsible on the easy side. Right now, I think they're wedded to hiking rates when I'm not so sure that's exactly the right policy right now. It could be, but they've hiked a lot, and obviously the market's still strong. But again, the stock market isn't the same stock market that it was even 15 years ago. The market, because of how the behavior modification that took place along the way with all the money printing in the last 25 years, when you couple that with the market share that the passive retirement investing has, that's Vanguard and BlackRock, that take these retirement date target funds and just invest the money. That's 50% plus or minus of daily flows. And so that's why you see all these stories about, 7 stocks are carrying the market, and the market cap of those 7 is some huge number, the entire S&P. I mean, it's a gargantuan number. I don't remember off the top of my head. Mm-hmm. So the markets have become warped by all of the prior QE and what the passive bid does to stock prices. So the Fed is saying, well, the employment report's not getting weak fast enough. I've talked about how that's distorted. The stock market's hanging on. Well, that's because it's a mechanical process. It doesn't have anything to do with the market looking down the road. And it retains a speculative element, and that's because of what the Fed, did and caused a whole generation of people to speculate like crazy in the 20 to 22 period. So they're looking at things that they have kind of warped and not looking at the environment. I think we may need to hike more. It's just not clear to me they need to do it now. Inflation is coming down. I think the inflation problem is going to be with us. They're not going to eradicate it. We're not going back to 2% prospectively. So if they were really worried about that, then hiking more probably makes sense. I saw a story, you've probably read them too, about, there were a lot of very, very wealthy people that got bailed out. When, if it would have run its course of liquidation, arguably 90 cents on the dollar would have flowed back to those investors. They shouldn't have bailed that entity out. So then that created an injection of easing to some degree. It's not QE, but it had a monetary impulse that it wouldn't have had if they'd allowed allowed it to go bust and work things out, and there would have been more ramifications. That problem also goes back to the Fed. The Fed was encouraging these people to, they were going to keep rates low for a long time. Mm-hmm. And they didn't do a good job of monitoring the banks to see what kind of trouble they were getting in, buying, financing their bond portfolio that might have a 7 to 10 year duration with overnight funds. So again, they broke that, and then they turned around and bailed it out. I think that was largely political, but that's neither here nor there.
Yeah.
So now something else has to break, and something will break, and then we'll see what they do.
Well, and I think that's what Dudley was saying in this op-ed, is like something will continue to break, and there's a lot of speculation out if there'll be more fallout from the regional banking system that we saw from SVB and First Republic and the like. Curious your thoughts there, but also there's a lot of speculation with the loans that will be revalued with corporate real estate. And so there's a lot of headlines about concern about that. The contrarian in me thinks that the more they're concerned is the less likely it's going to happen. But at the same time, you can't lie with the numbers. How are you approaching these headlines, and what are your thoughts on corporate real estate?
Well, I think that those are slow fuse type problems. So, I think that's something that people could get in trouble over, saying, well, we all know about it. It hasn't mattered yet, so it won't matter. Well, sometimes that's true, but in the case of commercial real estate, they're slow fuses, and they're one building at a time, right? They all have their own loan covenants and things like that. So the credit market has fuses. You have coupon payments to make, you have maturities, you got to roll the debt. You may be paying 5% as a corporate entity on your debt, but when that debt comes due, if you don't pay it off, you want to roll it, you might have to pay 8%. So there's a whole bunch of potential things that could trigger the avalanche that are just sitting there on the hill, just sitting there. I don't know what might be, but there are a lot of things like that could go wrong. And I think it's easy to think, well, they haven't gone wrong yet, so they won't. Well, I would remind you that it was March of 2008, prior to the collapse, when Ben Bernanke said subprime was contained and he had not even begun yet to metastasize. And he was the head of the Fed, and the Fed was in charge of regulating the banks. So he didn't know that. So he could have, and then you could have walked around for a while and said, well, see, he knows that, and it's not a problem. Well, it took a while for it to become a problem, and then we almost lost the entire financial system.
All right. And so, it was just today, another news headline was there was some stress test done. I don't know if it by the Treasury or by the Fed, that the banking system is healthy enough to withstand a severe recession.
Yeah, well, it might be healthy from a credit standpoint. I don't know. But obviously there's going to continue to be the slow disintermediation from the financial system, as long as short rates are so much higher in money funds than they are at the banks. And of course, if the banks want to raise their rates to keep the money there, then they're impinging on their profitability and their capital. So they're kind of in a heads I win, tails I lose situation.
Right. Bill, I wanted to ask you about China, and I know you talked to a lot of people that are really smart and know the inner workings of what's going on in that country. There was a lot about 3 or 4 months ago when China reopened. There was a lot of speculation that this was it. China's going to just rage back. Money is going to be flowing everywhere, but that rebound really has been lacking. And they also talk about them stimulating once again, and even that didn't do much for the Chinese economy. What are your thoughts on China kind of being that linchpin to getting global growth back and coming? Is it necessary, or is it even going to happen?
Well, I try never to have a big opinion about China because it's too easy to be wrong. It's a little bit like Russia. How do you know what data and news you're supposed to trust? I don't trust their news organizations, and I don't trust ours. So it's hard to get at what's going on. I think the reopening, where people were excited about it, I think has been a bit of a bust. And I think part of it could be because they're dealing with the hangover from all the real estate speculation and infrastructure that they put up. And, that's just my guess. Like I said, don't pay close attention to it just because I don't want to make decisions based on it when I know my data's no good. But obviously, if it was going to have a potent impact, it would have. The price of copper and oil, just to pick two, are down from when that happened. So I would argue that whatever's taking place is not all that potent.
Right. Well, I think copper is definitely screaming weakness, economic weakness. I assume especially when you consider the demand that the ESG green programs require. Right. Yeah. How about the commodities complex? What's jumping out at you here other than, Dr. Copper screaming at me, economic weakness, oil can't get out of its own way? What's it telling you?
I think, again, I don't know that commodities are particularly good leading indicators. They might be good coincident indicators. Maybe at a turn, an inflection point that if they break for no good reason, that'll give you a heads up. Right now, I don't think there's that much information. People are bearish on commodities generically. It's been an asset class, so to speak, that hasn't done very well, except for fits and starts relative to financial assets. So it doesn't have much mind share, and so I don't think it's really telling us all that much at this juncture. What prices are where they are because demand hasn't been all that potent. But if you told me that today was a low in oil and by November it was going to be $85, I wouldn't argue with you. I'm not saying it's going to happen, but I don't think the fact that last price of crude is 70 means that the next $10 are down.
Mm-hmm. Fair enough. How about gold?
Well, I'm bullish on gold because I'm bearish on these central banks. Central banks, they're incompetent. The currencies are all no good. The policies are wrong-headed. They're staffed by people who don't know what's going on. I mean, that's not to say they're not book smart, but they're not market people, and their track record proves it. So I'm bullish on gold as an antidote to them and as an antidote to, all this colored paper. I think gold's been out of favor from a North American investor standpoint for, quite some time. I think that, the recent weakness, could be coming to an end. A lot of times it gets weak in the quarter end, and a lot of times the June quarter end can be kind of the low for the year. I'm quite bullish on gold and silver. But if you'd asked me that 2 months ago, I would have told you the same thing, and it's done nothing but down in the last 2 months. So.
Yeah, right on. Okay, Bill, thanks for this update. It's really good to connect with you once again. Just always appreciate all your input and that you put out there and everything you do. And it's always a pleasure to have you on. I hope we can do it again. Tell us, people, where they can find your work. And also, I think you're also on Twitter at FleckCap. So, but how about your work?
At FleckCap is my Twitter handle. My website is fleckensteincapital.com. And I write a daily column, which I've been writing since 1995. It's kind of changed because the world's changed. And I also answer questions for people. It's a paid site because I'm not going to do it for nothing, but I'm not trying to get rich either. It's only about $10 a month. So. Yeah.
All right. Bill, have a happy 4th of July. Thanks so much for doing this.
Okay, Trevor, take it easy.